Henry Smith, Vice President and Investment Strategist of AB's Multi-Asset Solutions team. Hi, Henry. Thanks for being with us. No, Authors TV, it's a pleasure having you here. Thank you so much.
Hi there. Thanks for having me.
Henry, what are your views of the current macro environment as we move into 2026?
Sure. So I think the simplest way to describe the current macro environment is one that is resilient, but more complex than the headlines suggest. So we came into last year, 2025, with a long list of concerns. I'm thinking issues like trade policy shocks, geopolitics, stubborn inflation. And yet the global economy held up better than many expected. So growth surprised to the upside, inflation eased, and financial markets delivered pretty strong returns across a very wide spectrum. So equities, credit, and duration. The other point to note is that diversification also worked again, which is great after several fairly difficult years. But as we enter 2026, the story hasn't changed radically. The global economy is still expanding, albeit at a more moderate pace. The US remains the main engine of growth for the global economy, supported by corporate investment, particularly in technology and AI, and by a consumer that is still spending, even if more selectively. And at the same time, we are in a later stage of the cycle. So valuations are higher, especially in the US equity market, and credit spreads are tight. Inflation is also no longer the dominant threat that it was, but it hasn't really disappeared either, particularly in the US, where issues like tariffs and services inflation remain relevant. So to summarize, really, the environment today is not one of crisis, but it does demand more selectivity. The big takeaway for investors should be that while the market shows signs of macro stability, this does mask important divergences underneath. So we need to be active in our decision-making rather than simply riding markets passively.
And Henry, how resilient is the global economy as the economic cycle matures?
Sure. So resilience is probably the defining feature of this cycle, but I think it's worth noting that it's not uniform and it's not guaranteed. So if we think about the US, as I said, a major driver of the global economy today, the economy is showing surprising durability. So as I mentioned, corporate earnings are strong, capital expenditure is robust, and profit growth has broadened out beyond just a handful of technology names. The consumer also still matters enormously, and when we look at household balance sheets, they're not looking meaningfully overstretched. That said, there are signals we're watching carefully. I think it's well reported, but the US labor market has clearly cooled, hiring has slowed, job openings are down, and the risk is that a gentle slowdown turns into something sharper if confidence starts to weaken. This is why central banks, especially the US Federal Reserve, are increasingly focused on employment risks rather than just inflation alone. If we take a broader lens and think outside of the US, the picture is kind of mixed, but I think it's still constructive overall. So in Europe, growth is slower, but it does have lower inflation dynamics, which give policymakers a bit more room to ease further. If we think about places like Japan, this is in a very different phase. There we have firmer inflation and gradual policy normalization. And then when we look even broader than that into places like emerging markets, growth remains relatively resilient, supported by domestic demand and easing financial conditions. So I would say that our base case going forward is not recession, it's slower trend-like growth, but the range of outcomes from here is wider than normal, which is why it's important to think about resilience within portfolios.
Henry, with everybody talking about the AI, I want to ask you about that. Are we facing an AI boom or a bubble? And what might be the impact from here?
Yes, absolutely. Brilliant question. So I think AI is clearly a boom, but it's too early to call it a bubble at this stage. So there's no question that AI has become a dominant theme in markets. Investment in data centers, chips, and infrastructure has all surged, and that has meant that a relatively small group of companies have driven a large share of equity market returns in recent periods, and so that naturally raises questions for investors about concentration, but also how expensive markets are looking. So I think when we think about AI, it's important to separate excitement from excess. When you think about boom versus bubble, maybe we think back to the most obvious tech bubble of the late 1990s and think about where today's technology companies are. So today's AI leaders are highly profitable businesses generating real cash flows and funding investment largely from those cash flows rather than taking on large amounts of debt and leverage. So this is largely a market, at least at the top end, built on robust fundamentals rather than speculative businesses with no revenues. But I think the key risk to think about when it does come to AI is around timing. So AI investment is happening today, but productivity gains and revenue growth tend to come at a later stage and with a lag. If markets get impatient, if earnings don't catch up quickly enough, we could see periods of volatility or pullbacks, even if the longer term story remains intact. And of course, everybody's excited about the positive economic impact that AI could have. Clearly that's very significant. If AI is able to deliver meaningful productivity gains, it could help to offset some powerful headwinds that are occurring in the global economy, like aging demographics or deglobalization. And so what this would do is it would allow economies to grow faster without reigniting inflation. I would also highlight with the point of AI, everybody thinks to the US. I think it's worth noting that it isn't just a US story. So AI supply chains run through Asia into countries like Taiwan and South Korea. And so that opens up a broader and more diversified range of opportunities for investors who want to look beyond the kind of obvious winners.
And Henry, everybody is talking about AI and everybody is talking about geopolitics. How do geopolitical and institutional risks shape your outlook?
Excellent. Yes. So I would say that geopolitics and institutional risks are no longer just tail risks at the far extreme of outcomes. They actually form part of our baseline today. So we're operating in a world of persistent geopolitical tension, issues like trade fragmentation, ongoing conflicts, and rising competition between major economic blocs. So far, the global economy has absorbed these shocks remarkably well, but it doesn't really mean that these risks have gone away. And so one area we're watching incredibly closely at the moment is institutional credibility, particularly around central banks. So the independence of central banks and monetary policy is a cornerstone of economic stability. Any perception that this independence is being eroded, especially in the US, would have very serious implications for bond markets, currencies, but also risk premiums across the broader spectrum of investments. Another key factor is fiscal sustainability. Rising debt levels in developed markets may not be an immediate problem, but they limit policymakers' room to maneuver in the next downturn when it comes. Clearly that increases the risk of future volatility. So what I would sort of say is the key point for investors is that geopolitical and institutional risks don't usually show up gradually. They tend to resurface suddenly. And so that reinforces the case, as we've kind of talked about, for diversification and portfolios that are built on a wide range of different outcome options rather than optimized for one single forecast.
And Henry, the last question, how are you positioning multi-asset portfolios and what should investors be thinking about?
Sure. So our approach is to stay invested, but to do so more thoughtfully. So as we've kind of talked about, a resilient economy and easing monetary policy are generally supportive for risk assets. So we think stepping out of markets entirely at this stage carries a real real opportunity cost. But with valuations elevated and uncertainty higher, we need to be more selective, and risk management is clearly critical given that backdrop. Within equities, we still favor growth assets, particularly in the US, but we complement that exposure with diversification across regions, styles, and sectors. So as we kind of talked about, emerging markets linked to the AI supply chain are one example of an area where there's attractive growth, but valuations are much more compelling. In the world of fixed income, income is attractive again, but we emphasize quality. So credit spreads are tight, and so we're selective, and we do see duration remaining an important part of portfolios, but maybe more as a diversifier rather than just a source of return. And finally, I would sort of say that there is a role for defensive assets within portfolios. So I'm thinking of some allocations like perhaps low volatility equities or option-based strategies, or diversifiers like gold, alongside non-traditional return sources such as long-short strategies or event-driven strategies for investors who can access those types of alternative strategy. But what I would say is that the overarching message is that this is a multi-asset environment. The path forward is likely to be volatile from here. And so we see a wide range of opportunities available for investors who stay disciplined, who stay diversified, and stay focused on long-term objectives rather than short-term noise.
Looking for AI, also taking in account the geopolitics. Henry, thanks for being with us in Negocios TV. It's a pleasure having you here. Thank you so much.
Thanks for having me.
Thank you.